In this lecture, we're going to look at the two options for Caterpillar and Netflix, and let's try to understand how implied volatility affects option prices. So here we have two stocks. At the time we did these slides, Caterpillar and Netflix were trading almost exactly at the same price. Caterpillar was about 110 and Netflix was 109. So both are almost at the same price range. And we're going to choose an expiry series that obviously has the same number of days to expiry, because all monthly series do expire on the same day for all stocks. And therefore, if we have the same number of days to expiry, we're going to be looking at the same strike prices, and we're looking at the same price where both stocks are trading. So if we look at such a scenario, what we should expect is that the at-the-money options, in fact, at the money, in the money, or out of the money, all of these options should also be similarly priced. So let's look at Caterpillar options first. So what we see here is Caterpillar options. Caterpillar's trading for 110 and 22 cents. And we're looking at the April series. And the April series has 41 days to expiry. And you can look at either the puts or the calls, but the at-the-money options are going to be the 110 put and the 110 call. Now here you can see that the 110 call is going for $3.90, and the 110 puts are going for approximately the same, the $3.90. So again, we have a stock that's trading at 110. The number of days to expiry is 41, and the 110 calls and the 110 puts are going for about $3.90. Now let's look at Netflix options. Netflix is trading at 109.13. It's the same April series we're looking at with 41 days to expiry. And let's look at the 110 calls and the 110 puts. You can see the 110 call is going for $7.95, and the 110 put is going for even higher. It's about $8.90. Now, why would these two stocks that are trading at the same price, and we're looking at the same options, the same month of expiry, why would they be trading so differently? In fact, you can see Netflix is double. Netflix is literally double that of Caterpillar. Well, the reason is implied volatility. Netflix has a volatility that is going to be almost double that of Caterpillar. And how do we verify that? On the thinkorswim platform, whenever you put up the option series, you can see a percentage numbers here. And the percentage numbers tells you the implied volatility of that series. In the case of Netflix, this is 61%. And then you'll also see a plus or minus number. So in the next 41 days, Netflix is expected, one standard deviation range is plus or minus $18. So you can see from 110 plus or minus 18, that will give you a wide range of possibilities for Netflix to trade at. Now let's just go back and look at the Caterpillar. Caterpillar, as you can see, has an implied volatility of 29%. So the implied volatility of Caterpillar is exactly half that of Netflix, and therefore its options are also about half of what Netflix are. So this should give you a very clear idea that the volatility of the stock has a big impact on the prices of these options. And also you can see the the Caterpillar one standard deviation move is plus or minus 8.76, let's say plus or minus 9, whereas Netflix was plus or minus 18. So now you can see the more volatile a stock, the more its ability to go and hit strike prices, and the more its ability to move around. And once you have a volatile stock, then that volatility is going to price itself into the options for this stock. So this example should make it absolutely clear how option prices are going to get affected by the effects of implied volatility. So let's now look at the buyer and seller implications for this. So we have to look at, when we talk of implied volatility, we have to look at it from the angle of the seller. Because as far as the seller is concerned, his main concern is he getting enough premium to compensate for the risk of selling an option? We all know selling an option is a risky business. So whenever you sell an option, you have unlimited losses and limited profits. So the big concern for the seller is he getting adequate compensation for the risk? So in our case, if we looked at the real estate example, and let's say we're looking at the California example, if the seller received $25,000 for that $1 million property in California, he is obviously not getting compensated enough, because the volatility, the expected range for that piece of real estate in California can vary as much as plus or minus 200,000 in 1 year. And so in 60 days, then that standard deviation is probably going to be plus or minus 50,000, plus or minus 60,000. So, whatever calculation he does, he has to make sure that he is being compensated adequately for selling that option. So if he were to sell that option in California, he would probably look at getting about $60,000 on that option. So the way he would think about it is, if he gets $60,000 now, and even if in the next 60 days the value of that land increased by $50,000, he would still make a profit of $10,000. So that's the kind of calculation, that's the kind of thinking that is going to go on in the seller's mind. So, and that's exactly what we mean by he's going to assess the probability of this option going in the money. So if he got $60,000 as credit, then the strike price is 1 million, and then he gets 60,000. So the break-even point becomes cross 1,060,000. What is the probability of that? And that's exactly what he's going to be assessing. And this is the same kind of thinking you'll have to apply in the financial markets also. Whenever you're selling an option, if you do get into selling an option, you're going to have to think, okay, are you getting enough premium to justify the risks associated with selling an option? So now, if implied volatility decreases, if the volatility decreases for some reason after he sold the option, now that's great, because then the value of these options are going to fall. So now we're talking about a financial market. Let's say Netflix had a volatility of 60%. And after someone sells that option, let's say Netflix volatility dropped to 50% or 45%. Now that's great for the seller, because the seller has captured a lot of premium based on a very high volatility number. Therefore, in any options transaction, the seller is going to be thinking or looking for implied volatility to come down after he has sold the option. Whereas the buyer, it's exactly the opposite. When the buyer wants implied volatility to increase after he has bought the option, this is very important. Both of these statements apply after the transaction has happened. So if the implied volatility increases after the buyer buys the option, what does that do to the option price? Whenever you have an increase in volatility, the option price is going to increase. And because you're a buyer of options, you're going to have to sell this option to realize your profits. And therefore, you want to always sell it for a higher price. Whether it's a call or a put, it doesn't matter. If you're a buyer, you've already bought the option, and the way you're going to profit is if the value of this option goes up. And if implied volatility goes up, that automatically pumps the air into this option, and the option increases in value. So always the buyer would want implied volatility to increase after he has bought the option, and for the seller, they would want implied volatility to decrease after he has sold the options. So that's as far as implied volatility is concerned. Before we close out this lecture, I just want to briefly talk about the VIX index. The VIX index is a measure of volatility in the markets itself. The VIX index started in about 1993, and it tries to measure the overall volatility in the market. And the way it does that is that it calculates the market volatility based on the S&P 500 index as a whole. So the S&P 500 index trades in the options market under the symbols SPX, which is the real index, and then there's 1/10 of that index called SPY, which is the spider. So the VIX index has a complex calculation where it tries to calculate the supply and demand of the S&P 500 itself. Now, whenever the VIX increases, that means volatility is coming into the market. And whenever the VIX goes down, then volatility is coming out of the market. And whenever you have a higher VIX index, this kind of an effect is going to be felt on all the stocks in the S&P 500. And we know that the S&P 500 represents the 500 largest and most important companies in the United States. So a high VIX automatically pumps up the volatility of the individual stocks. Now, the VIX index is covered in detail in a future course, so I just want to give you a flavor here of what this VIX index is. So whenever you do any trades or whenever you're trading in the markets, it's always good to see where the VIX index is. And you need to understand the VIX index a little better because it's a very critical index, and it can tell you when the market is on the edge or when the market looks very stable. There's a lot of things that you can study from the VIX. So this VIX index is covered in detail in a future course. Now, in the next lecture, we're going to cover option Greeks. Now, this is a critical part of options trading, so we'll go into the detail of option Greeks and all the 4 Greeks: delta, gamma, theta, and vega.